We shall commence this module by discussing about link between money output and prices. The interrelationship between money, output and prices, which is at the core of macroeconomic monetary theory, is typically encapsulated in the form of a demand function for money. A stable demand function for money has been recognized as an essential prerequisite for the use of monetary aggregates in any meaningful conduct of monetary policy in all economies, irrespective of their stage of development. Thus, it has relevance not only for developed economies like the USA, but also for an emerging market economy like India, particularly when we consider the role of monetary policy in inflation management. For an economy undergoing an adjustment program, the existence of a stable money demand function, it is often regarded, gives hope to policy makers in their search for a target of monetary aggregates consistent with other policy objectives like price stability. The link between the demand for money balances and aggregate income is one of the central themes in the theory and practice of monetary economics and is a recurring issue in the literature on money. The ongoing financial innovations and regulatory changes reopen the question of stability of the money demand function. After starting this module, you shall be able to know about the money demand function in advanced economics, know about money demand functions in India, understand the importance of stability, evaluate the impact of innovations on money demand function, analyze the evidence available on the stability of money demand function. Let us now discuss about the demand for money. Money demand function in advanced economies. The research on money demand function in the developed economies have been quite a few. The search for stable money demand function has evolved through two distinct phases. In the first phase, up to the early 1970s, wherein theoretical developments were synthesized to arrive at a broadly acceptable form of money demand function. In the second phase, it was dominated by the failure of the standardized money demand function and its aftermath. It involved an investigation of the proximate causes of instability as well as empirical issues leading to new promising directions. The early money demand function was log linear in specification and was based on annual data. Log m upon p is equal to beta 0 plus b1 log yr plus b2 log first, where m is equal to money where m is equal to money stock, p is equal to price level, yr is equal to real income, I is equal to interest rate. The inclusion of a scale variable like real income y was because of the transactional theory of money, where money is held for transaction purposes and interest rate was incorporated because of the asset theories of money demand, where interest is the opportunity cost of holding money and demand for money is a problem of portfolio choice, allocating wealth among a portfolio of assets including money. Most of these studies after 1950s used the above functional form of the demand for money, differing in either the sample period or the choice of dependent and independent variables. Thus, empirically, the differences were on three issues. First, whether the dependent variable should be narrow money or broad money. Second, whether the scale variable should be real income as in transaction theories or wealth as in the asset theories. Third, whether short-term interest rate such as a treasury bill rate as in transactions theory should be considered as the opportunity cost of money, or should it be several rates of interest reflecting a broader range of money substitutes favored by the asset theories. Later, the studies differed in using quarterly rather than annual data or using the partial adjustment mechanism, by using a lagged dependent variable in the money demand equation. This was done in a study of US economy up to 1973 by Goldfeld using narrow measure of money, real income and short term interest rate like treasury bill rate or commercial paper rate along with interest rates on saving deposits. However, over a period of time it was found to be unstable. Since by this time most central banks in advanced economies were targeting monetary aggregates, the research shifted to focus on financial innovations and deregulation as causes of instability and incorporating these in the money demand function, causing its downward shift because financial innovations tend to reduce the transaction cost of converting other assets into money. This in turn allows money holders to keep smaller money balances and finance their transactions by shifting or transferring their funds from higher interest bearing alternatives. This causes the demand for money to shift downwards. It is however difficult to have a conclusive confirmation on the innovation hypothesis because reliable data on transaction cost is hard to come by. To analyze the impact of financial innovations on the velocity of money, we need to consider three types of financial innovations. First, development of investment products whose restructure leads to financial disintermediation between issuer and the saver. Second, development of future products which cater to diverse expectations of the agents in the economy. Third, improvements in transactions because of developments in information technology with implications for market liquidity. The first and the third factor impinge on the money demand. The impact of financial innovations on the monetary targeting framework depends on whether the payment system was bank based or market based and the degree of financial maturity of the economy. In the case of market based economies such as the USA, the resultant process of financial disintermediation meant that the existing money stock could support a higher volume of output by increasing its velocity, and with this unstable income velocity, the relationship between money output and prices broke down, and hence many central banks abandoned monetary targeting. In the case of bank-based systems like those in France and Germany, innovations were often bank-driven, so they could persist with a variant of monetary targeting. In the case of developing countries, the velocity of money typically falls in the early stage of development with the monetization of the economy and then begins to rise as financial deepening results in disintermediation. In these countries, the rapid financial innovations leads to a continuous process of monetization where decline in income velocity could be arrested. The relationship between improvements in the payment system and the velocity of money is also related to the legal infrastructure. In the case of debit and credit cards, if the settlement is on a net basis through the banking system, these cards effectively become near monies, which impact the stability of money demand. Empirically, researchers tried to study the instability of the demand for money using narrow and broad measures of money. Alternate measures of transactions, wealth and interest rates were tried, but despite temporary stability of the money demand function in the long run, it was unexplained. So the research shifted to time series techniques by the later half of the 1980s. Most money demand functions are of the types MT is equal to B0 plus B1 PT plus B2 YT plus B3 IT plus ET, where M is the long run money demand. The postulate of a stable relationship between the macroeconomic variables concerned holds if and only if the fluctuations in money demand are temporary, or if a long run relationship is to hold the time paths of the variables, or their combination is stationary, or the error term. ET is equal to MT minus in bracket B0 plus B1 PT plus B2 YT plus B3 IT should be stationary. The test of stationarity of the error term is called co-integration, and most of the recent research in money demand focuses on this. Capturing financial innovations in the money demand can give stability to the short-run money demand if the interest rate in it can correctly price the opportunity cost of financial innovations or adjust for structural breaks. For example, if the money demand function is run with rates of interest on near monies like saving accounts and money market mutual funds, or incorporates a proxy for economic uncertainty like weighted index of fluctuations in the prices of the various segments of the financial markets and real activity. This may give stability to the money demand function in the short run in the former case, and in the long run in the latter case. Instability of the money demand function in advanced economies is limited to the market-based economies where financial innovations tend to diminish the role of the banking system. Recent research has shown that with financial innovations and deregulation, the distinction between transactions and other motives for holding money has become empirically obscured. Use of weighted monetary aggregates has also been tried with weighting of the components of broad money by the degree of moneyness of each component. Its advantage over simple sum aggregates and its use as an explanation of instability and use in policy formulation is hampered by conceptual and operational problems. The dynamics of the short-run adjustment process has also been captured in the buffer stock or disequilibrium approach to money by Laidler and Goodhart, where the rationale is that economic agents respond to successive monetary shocks by their impact on certain buffer assets. The rationale of this theory is accepted, but it has not been modeled empirically in a generally acceptable way. Moving on to discuss the money demand function in India. In the earlier studies for the period 1935 to 1955, attempts at estimating money demand functions using non-farm income instead of national income as a scale variable and treasury bill rate as a short-term rate and yield on government securities as a long-term rate were made. Some found the long-run real income elasticity between 1 to 1.5. In the early 70s, the research focused on examining sectoral rather than economy-wide demand for money. Separate household sectors' demand for money and for business demand for money were analyzed. As a scale variable, household disposable income along with long and short-term interest were found to be significant and affected by portfolio shifts in monetary assets as well as shifts in rural to urban income. As for business demand by private as well as public limited companies, the demand for money was influenced by income, current expenses, assets and call money rates. It was better affected by combination of quick assets and sales rather than by sales and wealth. As for conventional analysis as a stock variable, personal disposable income or permanent or expected income instead of national income was found to perform better with income elasticity of money demand exceeding unity. As a choice of monetary aggregate or dependent variable, broad money M3 rather than M1 had better explanatory power and stability of parameter estimates. Study by Singh Shetty and Venkatachalam for the period 1970-71 to 1980-81 presented quarterly demand functions for the components of broad money based on quarterly income series and using partial adjustment mechanism found the long run income elasticity of currency to be below unity 0.86 while that of demand and time deposits exceeded unity 1.41 and 1.80 respectively. In the case of nominal interest rates measured by 3-year deposit rate, the long run elasticity was found to be highest for time deposits 0.70 and lowest for demand deposits minus 0.33 while that of currency minus 0.25. Bhole 1985 estimated money demand functions separately for M1 and M3 using annual data for 1950-51 to 1979-80 with income, interest rate proxied by 1 year term deposit rate, expected inflation measured by 3-year moving average of actual inflation rate and lagged money stock as the explanatory variable. He got significant results using a linear model with nominal and real money stock as separate dependent variables. A study by G.S. Gupta for the period 1954-83 confirmed Friedman's hypothesis in explaining demand for narrow as well as broad money using permanent income. Rangarajan estimated the demand function for broad money in the inverted form with the general price level being dependent on nominal money stock and real income. Using annual data for period 1961-62 to 1986-87, he found real income elasticity of demand for money to be 1.9. Another study found demand for money to be influenced primarily by the transactions motive and adjusted real income. Jadhav ran disaggregated demand functions for currency, demand deposits and broad money to investigate whether income, own rate of return, return on competing assets, price expectation etc. satisfactorily explain the demand for money in India and whether the money demand functions are intertemporally stable. He proxied the nominal rate of return on bank deposit by a weighted average of various fixed deposit rates with weights based on the overall maturity pattern. The nominal interest rate on alternate or competing asset by the interbank call money rate and the expected inflation rate was proxied by the 3-quarterly moving average of actual inflation rates. The demand for broad money run on real income (YR), real weighted average of fixed deposit rates (RLI) as the own rate of return, real call money rate (RI2) as the opportunity cost variable and the lagged dependent variable as the set of explanatory variables appeared to be the best fit. Correction had to be made, however, for autocorrelation. Recent studies on the money demand function used modern time series techniques to examine if money output and prices are co-integrated and were able to estimate a robust demand function when they captured the changes due to financial liberalization. In fact, the report of the working group on money supply chaired by Y.V. Reddy estimated the broad money equation and found real broad money balances and aggregate income to be co-integrated with the income elasticity of broad money at 1.5. They found long-term equilibrium relationship between real money balances and real income with only short-term deviations. The estimated demand equation for the new broad money aggregate NM3 used the index of industrial production as a proxy for output, which despite being a limitation gave interest rates and exchange rates as important determinants of money demand. In a study for the RBI, a co-integrative approach was used to estimate money demand function by Ashok K. Nag and Ghanshyam Upadhyay. This led to a reasonably stable money demand function for India with yield on ordinary shares emerging as a good proxy for opportunity cost of narrow money. The principal sources of change in money stock demanded emanates from the changes in transactions level, while a rise in the opportunity cost of money as expected depresses the demand for money. It is observed that movement in gold prices do have an impact on the level of money demand in the short run. In another study for the RBI to analyze the stability of the demand for money in India, Himanshu Joshi and Mridul Sagar examined if there existed an underlying equilibrium relationship between real money balances and a given set of variables that explain it, including the aggregate real income. This question was explored by studying the long-run monetary relationship and its short-run dynamic adjustments through application of co-integration and error correction procedure. They incorporated aggregate real income and considered the rate of inflation as an opportunity cost variable. They also included a measure of the stock of financial wealth in the model to capture portfolio decisions affected by agents among financial assets and the national product. Examining the stability of money demand relationship is important as shifts in functional relationship has vital implications for monetary management. Next, we shall discuss the significance of stability of money demand for policy formulation. Case for developed economies. The significance of a stable money demand function for monetary policy with aggregate activity as endogenous variables lies in the fact that it facilitates the setting out of parameters which are useful for the central bank to control monetary aggregates to stabilize the economy. The test of a stable money demand function which has applied policy utility to a great extent lies in its predictive power reflected in its out of sample forecasting performance. Under the ISLM framework, the stable money demand translates into a stable positioning of the LM curve, and if IS curve also turns out to be stable, it implies money supply can have a predictable influence on the level of activity. In practice, we lie in a stochastic world in which random shocks disturb IS-LM relationship and the efficacy of targeting money supply rests mainly on the stability of money demand function, as Friedman had argued that the money supply cannot influence real output in the long run, and given this neutrality proposition, stable money demand functions provides credibility to the quantity theory with a predictable influence on the general price level. Central banks all over the world have long recognized the existence of stable money demand functions as a key to effectiveness of monetary policy. It has a special role to play in control of monetary aggregates for inflation management. Evidence on demand for money by and large supports the hypothesis of a stable relationship in money output and prices. Following Goldfeld's examination of quarterly post-war data for USA, money demand function was found to be more stable based on a narrow definition of money and when current income rather than wealth and interest rates on short-term instruments like treasury bills or commercial paper rates, along with the lag-dependent variable were incorporated as explanatory variables. However, out of sample forecast from Goldfeld's equation began over-predicting real money balances since 1974, and this led to a lot of research across the globe to find out whether innovations, liberalization and institutional changes in financial markets have caused shifts in the money demand relationships. It was found that with the exception of Canada, narrow money demand remained stable in the case of France, Germany, Japan and United Kingdom. The evidence on stability has been limited to a few episodes or periods or a few countries. Let us now look into the case for India. The empirical evidence on the demand for money in India also supports the hypothesis of a stable long-run relationship. While reviewing the earlier works, Vasudevan observed that the literature suggests that money demand in India responds more to income than interest rates, and the broader definition of money yields a more stable demand function. Singh et al., however, preferred a relationship with narrow money stock, though they too found a predictable function of a limited number of explanatory variables using an approximation for activity at quarterly interval. Numerous other studies followed confirming stable money demand while throwing a mix of evidence on the relative stability from different specifications and different money stock measures. However, the money demand relationship is far from settled in the Indian case. The financial structure has undergone a considerable change over the years. The nationalization of 14 commercial banks in 1969 has made the 70s different from the experience of the 60s. More importantly, the demand side could have been influenced more directly in the 80s with the developments in the capital markets having a profound bearing on the money markets. Portfolio substitutions appears to be pronounced in the 80s. An example is growing investment of households in shares and debentures. These instruments accounted for merely 3.7% of gross household saving in financial assets in 1980-81 but increased to 22.2% by 1991-92. Today, a host of mutual funds operate in capital markets and provide portfolio management services to households as well as corporate. Also available on tap are small saving instruments used by the government to finance fiscal deficits, a fledgling market for government debt, a buoyant market for primary issues in stock market, a number of new instruments in both these markets, the introduction of instruments such as certificates of deposits and commercial papers have brought about new elements in which money demand would have to be studied afresh with eye on possible shifts in the function. With the framework for empirical testing having undergone a radical shift, better results are expected. Let us now recapitulate what we have learned in this module. In this module, we discussed the importance of stability of the money demand function, empirical evidence on the stability being dependent on choice of determinants of money demand function, the importance of stability of the money demand function for policy formulation in the case of developed economies and India, the impact of financial innovations on the monetary targeting framework depends on whether the payment system was bank based or market based and the degree of financial maturity of the economy. Capturing financial innovations in the money demand can give stability to the short run money demand if the interest rates in it can correctly price the opportunity cost of financial innovations or adjust for structural breaks.